Hi, my name is Ryan B. Lorete from 3B. The starting point of making good financial decision is always the analysis of your own business financial situation and needs. We are now on the second step of making good financial decision, which is to estimate your capacity to finance your own business plan or your capacity to support the amount of debt you want to take out. In this stage, you will be able to determine your business limits in repayment and debt capacity. Usually, yung mga lenders na may limit kung magkano ang pwede nilang ipautang sa client. Para malaman nila yung limit na yon, they will calculate the client's so-called equity ratio. So, ano nga ba yung equity ratio? It is a ratio that reflects how much of the business the client is supporting with his or her own fund or equity. Pero ano itong equity? Equity is the value of all your assets minus the debts you have, both formal and informal, including the debts to suppliers or private individuals. Another term of equity is net worth. If the equity ratio reaches 0 or becomes negative, ibig sabihin 0 or negative din ang equity. Yung business na may pautang na katumbas o mas malaki pa sa value na kabuang assets. If the debt is too high and the equity ratio is too low, then the business is not capable to making profit. If the sales is no longer possible and business with zero or negative equity typically results in bankruptcy. So ngayon, punta naman tayo sa rule of thumb. In planning a large investment for expanding your business, it is very important that you are able to determine yourself if your investment is within your maximum debt capacity. Maximum debt capacity is the maximum amount of debt you can afford at one time, regardless how low the installment is. A rule of thumb is that the equity ratio should not be below 30%. So to determine your maximum debt capacity, it is important to estimate your current equity ratio and check if your equity ratio does not below 30% and when you take an additional debt for a new installment.
Hi, I am Lyra Espartero from 3B. I will now explain the example calculation of equity ratio. So, Mr. Alexandro sees opportunities to invest where he wanted to construct a silo to save the expenses of a silo rental. Silo, it is a bulk storage for his crops. He also wanted to invest in a dairy market. So, in order to determine his debt capacity, Mr. Alexandro must compile the current balance sheet to compute the current equity and the equity ratio. So, if you look at the balance sheet, meron pong assets at liabilities. Assets are the items with economical value, while the liabilities, ito naman yung utang or loans. So, may total assets siya na 1,261,600 at total liabilities na 810,000. So, paano i-compute ang equity? So, total assets minus total liabilities is equals equity. So, 1,261,600 minus 810,000 is equals 451,600. Yung equity niya ngayon ay 451,600. So, ngayon, kailangan nating malaman ang equity ratio. So, to compute the equity ratio, it should be equity divided by total assets. So, sa sample balance sheet, ito ay 451,600 divided by 1,261,600. So, yung equity ratio sa balance sheet ni Mr. Alexandro ay 36%. So, the rule of thumb of equity, dapat hindi ito bababa ng 30%. Since 36%, it is an indication na mamamanage ni Mr. Alexandro yung business at mabayaran niya yung mga utang or loans niya. So, lastly, good to know that fair evaluation of assets, it is most important to consider the fair value. So what is the fair value? It is the sales price agreed upon the uh, willing buyer or sellers. That's all. Thank you.
Good day, ma'am. I am Mary Grace V. Kiner, 3B Pabi student. My topic that I would like to discuss is the current investment plan of Mr. Alexandro. Mr. Alexandro would like to construct a silo of 200,000 and start a dairy operation of 450,000 that he would like to finance with a loan amount of 650,000. In order to calculate the expected equity ratio after the investment is made, Mr. Alexandro must adjust his balance sheet to reflect both the new silo and all assets related to the dairy operation and the loan. So now, the total amount of all the assets of Mr. Alexandro is 1,911,600. And the total liabilities amount is 1,460,000. So, in order to compute the equity, we just subtract the total assets and the total liabilities. So the amount of the total assets is 1,911,600. So we just subtract to the total liabilities with the amount of 1,460,000. So now the equity is 451,600. So in order to get the expected equity ratio of Mr. Alexandro, we just divide the equity to the total assets. So now, the amount of the equity is 451,600. And we just divide it to the total assets with the amount of 1,911,600. So, the expected equity ratio is 0.24. So we convert it into percent, that is 24%. So the amount of the equity remains the same because no funds would be contributed to the project by the owner. However, the expected equity ratio would change to 24%. So since the original investment plan put the expected equity ratio below 30%, Mr. Alexandro must adjust his investment plan so that it is an amount of credit his business can currently support.
Hi, my name is Shalomay D. Angilio from 3B Pabi. My report is all about adjusted investment and calculation of equity ratio. Since the original investment plan put the expected equity ratio below 30% of Mr. Alexandro must adjust his investment plan so there is an amount of credit his business can currently support. Mr. Alexandro adjusts the high investment plan by deciding only to construct the silo for RON 200,000. To adjust his balance sheet, Mr. Alexandro adds RON 200,000 to his fixed assets and RON 200,000 to his medium and long-term liabilities. In his current estimated balance sheet, the adjustment leads to total assets of RON 1,461,600, total liabilities of RON 1,010,000, and equity of RON 451,600. Pag tinignan mo ang balance sheet, wala na yung dairy equipment and livestock kasi nag-decide si Mr. Alexandro na silo na lang ang co-construct. So, RON 200,000 na lang ang kailangan. Kaya 200,000 nilagay sa fixed assets kasi yung silo is considered fixed asset. Property siya, may value siya in the future. Since fixed asset siya, considered na medium and long-term liabilities, so yung amount sa loan for investment plan is 200,000 na lang din. Mr. Alexandro's calculation, formula, Total assets minus total liabilities equals equity. Total asset equals 1,461,600. Total liabilities equals 1,010,000. 1,461,600 minus 1,010,000 equals 451,600. Equity niya is 451,600. Since kailangan natin malaman ang equity ratio para makita if kaya niya ba suportahan ng investment, formula for equity ratio is equity divided by total assets equals equity ratio. 451,600 divided by 1,461,600 equals 31%. Expected equity ratio niya sa adjusted investment plan is 31%.
Hi ma'am, I'm Jomelyn A. Velasco. I am the fifth presenter in our group. We are now on the third step of financial decision making. Select condition that match your business and investment. After determining which financial product suits your investment and your capacity to repay the loan amount, it is time to request offers from potential lenders and make applications. It is important to verify the conditions of the products being offered by the lenders, especially the loan maturity, the interest rate, and the cost of borrowing. There are three types of loans. The first is the working capital loans, the second is the fixed asset loans, and the third is mixed purpose loans. For short, the working capital loans is a loan for funding your business, like pambayad sa rent, sa mga labor, at sa mga everyday expenses. Then, ang gina-cover lang ng loan na ito is yung short-term debt lamang. Regarding the interest rate of the working capital loans or the working capital facilities can have either a fixed or a variable interest rate. Some institutions have recognized a demand for fixed interest rate because it makes it easier for small businesses to predict their cash flows. When you say loan maturity kasi, it refers to the date on which a borrower final loan payment is due. Sinasabi din dito na ang loan maturity ng working capital facility ay nakadepende sa kung anong klase o kung anong type na investment you are making. Working capital loan facilities are by nature short-term mula sa one crop cycle para sa temporary na pangailangan hanggang sa 1 o 2 taon for permanent working capital needs. At halos lahat ng mga lenders ay nag-offer ng revolving loans or credit lines para sa temporary na working capital.
Good day, ma'am. I'm Marvin Daliego Gabayan, and this is my part of this activity. Fixed asset loans. Fixed asset loans refers to the loans you want or your desire either for construction, expansion, renovation, or to purchase fixed assets like buildings, land, vehicles, or some machineries. These are those physical values that you can value or you can sell in the near future. Interest rate. It is the interest rarely offered for maturities longer than 3 to 4 years in Romania. They don't give fixed interest rate if your loan long less than 1 year. Maturity refers to the due time of your payment. Mostly in fixed asset loan, it is medium or long-term loan, meaning there are 2 or more years in term loan because the investment in fixed asset is big and it will generate in a good profit in the near future.
Hi ma'am, I'm Ethelbert M. Nieves from 3B. My report is all about the third types of condition that match your business and investment mixed purpose loan. Mixed purpose loan is a combination of working capital loans and fixed asset loans. This loan is intended for business na kinakailangan ng working capital, for example, funds for operating business. At fixed asset investment, bibili ng property, machineries, or any assets. There are financial institutions na hindi nag-offer ng mixed purpose loan, so instead, they will offer 2 loans which is both the working capital facility and investment loan. In the case na may lending company na nag-offer ng mixed purpose loan, they offer the maximum maturity of 3 or 4 years and they either have fixed, fixed or variable interest rate. If you are applying for both working capital and fixed asset loan, dapat i-discuss ito sa lending company na uutangan mo for further assistance and options at para na rin mag-guide sa kung ano ang mas okay sa business plan mo. Yan lang po ma'am, maraming salamat.
So, hello everyone. My name is Remark Isanot, a third year Practical Agriculture B, and my topic is all about the understanding of interest rate. So first, we must understand what is interest rate. And the interest rate is the amount of a lender charged for the use of asset expressed as the percentage of the principal. The asset borrowed could include cash, customer goods, or large asset such as vehicle or properties. When a financial institution makes you an interest rate offer, the institution take into consideration it cost funding plus several factors that could cost you to not repay your loan. The financial institution also assess the financial stability of your business. Like for example, gaano nakatagal ang business mo if may business ka? Gaano kalaki yung profit na nakikita mo doon sa business mo? And sa credit history, gaano good payer ka ba? Malalaman ba nila good or bad payer ka? Quality at relationship sa iyong collateral. The more na stable ang business, the more stronger your credit history. The more valuable and important your collateral and maayos ang relationship mo with the financial institution, mas malaki ang chance na mabigyan ka ng lower interest rate. So, in interest rate, there are two types of interest rate, which is the fixed interest and the variable interest. So first, you must to understand what is the fixed interest. So fixed interest is a rate that remains the same over the life of the loan. Hindi siya nagbabago hanggang sa matapos mo ang loan mo. So yun ang example ng fixed interest. Wala siyang posibilidad na magbago yung loan mo, yung binabayaran mo sa loan mo, ganun pa rin siya hanggang sa matapos mo siya mabayaran. So variable interest rate is a rate based on the reference interest rate and fluctuates over the life of a loan. Nagbabago siya, pwedeng tumaas or pwedeng bumaba ang interest rate. So why the variable interest rate is changing? The reason why it's because the code of the bank has for obtaining fund is also constantly changing. And like for example, yung time deposit mo sa bangko will mature after 3 months. And then the interest rate after mag-mature ang time, ang dineposit mo pwedeng tumaas o pwede ring bumaba. This will impact the cost that the financial institution has to support in order to continue to lend clients like you. So, yun pala yung yun yung example ng variable interest kung bakit siya nagbabago-bago. So, two types of interest rate which is the fixed and the variable interest. So, once again, my name is Remark Isanot, the third year Practical Agriculture B, and that's all for my report. Thank you.
I am Carl Jamud Simalidas, and now I will discuss the pros and cons of fixed rate and variable rates. But before that, what is pros and cons? These are advantage and disadvantage, or favorable and unfavorable. So, proceed na tayo sa pros and cons of fixed rate. First, fixed rate generally higher than a variable rate at the same time of contracting the loan. Okay? So, ganito yun siya. Since mataas ang fixed rate than variable, kasi ang fixed rate is sure ka na sa iyong interest in a monthly, and not like variable is pwedeng magbago, hindi ka sure, kaya minsan is pwedeng tumaas, pwedeng bumaba. Not unlike the fixed rate is naka-stable yung interest payment mo. Next, if you choose a fixed rate and the reference rate falls, your monthly payments will be higher than if you had chosen a variable rate. If the reference rate rises, your monthly payments will be lower than if you had chosen a variable rate. So since ang fixed rate is fixed at hindi siya pwede magalaw or hindi pwede magbago, pag bumaba ang reference rate, so mas mataas ang monthly payment mo kaysa variable rate. At pag tumaas naman yung reference rate, mas mababa ang monthly payment mo kumpara sa variable rate. Next is the pros and cons of variable rate. Generally, lower than a fixed rate at the same time of contracting the loan. So bakit nga ba siya mababa? Kasi ang variable rate is naka-base siya sa reference rate. So masabay lang siya sa reference rate, not like the fixed rate is fixed na siya. Kaya ang variable is pwedeng tataas, pwedeng mababa. So may rise or fall as the reference rate changes. This means your payments may vary on a monthly basis. Kaya siyempre, kaya nga kaya nga minsan nagbabago yung monthly payment mo kasi nga yung reference rate is nagbabago-bago rin. So pag bumaba in this month yung reference rate mo, mababa rin yung monthly payment mo. Pag next month is tataas yung reference rate mo, so tataas din yung monthly payment mo. And if you choose a variable rate and the reference rate rises, your monthly payments may become higher than if you had chosen a fixed rate. If the reference rate falls, then your installment will become lower than if you had a chosen fixed rate. So tulad na nasabi ko kanina, kaya nga pag bumaba, ang variable rate is naka-base lang siya sa reference rate. Kaya pag bumaba, when the reference rate rises, so your monthly payments will become higher than. Kaya nga higher than kasi sumasabay lang siya sa agos ng reference rate. Kung mataas ang reference rate, so mataas din yung monthly payment mo. And if you had chosen a fixed rate, if the reference rate falls, pag bumaba, then your installment will become lower than. So yun, pag bumaba ang reference rate is bababa rin yung mas mababa rin yung monthly payment mo. Kasi nga ang variable rate is naka-base lang siya sa reference rate, not like the fixed rate na fixed lang siya.
My name is Faith Joy P. Camacho, 3B pa B. My report is Effective Cost of Borrowing, How to Choose the Loan with the Lowest Cost. Tip 1. When comparing two offers, compare the effective interest rate or the effective cost of borrowing rather than the nominal interest rate. Lenders typically quote their nominal annual interest rate. Ano ba ang nominal interest rate? Ito yung rate na hindi pa included lahat ng cost na related sa loan. Sample ng related cost ay management fees, analysis fees, at bawat lenders ay iba-iba. And the real cost of loan increased from 1.5% to 4.5%. Nominal interest rate plus all other costs related to a loan changed by a financial institution is called effective interest rate. Usually, but not always. All the charges related to the loan can be found in the repayment schedule or the complete table showing the detailed and specific terms of borrows. You can also request from the financial institution the repayment schedule. You must take into consideration that there are other obligatory costs, the insurance, and other expenses. Take note that looking at effective cost of borrowing is a better way in choosing the loan with the lowest cost.
With
Good day, ma'am. I am Marily Pansoy, 3BPB student. Effective cost of borrowing, or how to choose the loan with the lowest cost. Tip number 2. Choose repayment schedule that minimizes your effective cost of borrowing. So what is repayment schedule? It is a document detailing the specific terms of borrower, such as monthly payment, interest rate, due dates, at iba pa. Repayment schedule has a large impact on the total effective cost of borrowing, especially in the farmers, since farms' income is irregular, usually 1 to 4 times a year. For the same amount, maturity and effective interest rate, alone with a higher or fewer installment, like biannual repayment schedule or twice year lang nagbabayad, will have a higher effective cost of borrowing compared sa loan na mas maraming installment like quarterly repayment schedule or 4 times a year nagbabayad. Minsan, mas practical na biannual ang repayment schedule kasi tugma siya sa cash flow mo, lalo na sa farming business. Pero, mas mataas lang talaga ang effective cost of borrowing. When faced with decision to choose between different repayment schedule, na sigurado kang mababayaran mo galing sa cash flow mo. Piliin ang may mas maraming installment. That way, ma-reduce mo ang effective cost of borrowing mo. To see clearly the impact of the repayment schedule on the effective cost of borrowing, you can calculate the total interest and charges appearing in the repayment schedule provided by the financial institution. That's all. Thank you.
Hello, this is Ella May Sibayan from 3BPB. My report is all about how to match maturity with the investment. How to match maturity with the investment. Business opportunities sometimes come up on a short notice with a very short time frame to make a choice. The most common example is when the owner of the land you rent wants to sell the land. In this case, you have a short time to pay the owner before she or he sells to another buyer. When opportunities like this arise, you need money fast to make a purchase but don't always have time to wait for an approval from the bank. So, you take the money you have to pay for the investment, usually from your working capital. So, what is working capital? It is the capital of a business which is used in its day-to-day trading operations, calculated as the current assets minus the current liabilities, or the money which is available for use immediately rather than the money which is invested in land or equipment. Meaning, yung hawak-hawak nating pera na magagamit natin agad. Then softly, after a short period of time, your working capital is low. So, you request refinancing for your working capital. But wait, aren't you actually financing then the purchase of land, a fixed asset, with a working capital loan facility? Shouldn't you allow yourself to pay for this investment over a longer period of time? The situation described above is what lenders call depletion of working capital, as I have said earlier, which simply means you have used your working capital for longer-term investments. This is a problem because working capital funds are the funds that need to circulate in your business, transforming from inputs into crops, into cash, and back to inputs to replant. So, if working capital is depleted, then you may not have enough funds available to plant your next crop. This is a problem for both you as a farmer and your financial partner because it puts stress on your business when you finance long-term investments with short-term financing. If this is the situation that has occurred, it is better to discuss with your financial partner options to avoid refinancing the investment with short-term facilities. A longer-term investment loan to reimburse the funds you used to make the investment out of your working capital, or a permanent working capital loan would be more appropriate to replenish your working capital and ensure that you do not run into refinancing problems in the future. And we should always be smart in choosing our investment and be cooperative to our trusted lending companies in applying for permanent working capital loan to them. This is to avoid using up all your working capital and compromising things running your business.
Hi ma'am, my name is Laravel R. Abilio from 3BPB. My report is all about an example of a balance sheet with unbalanced liabilities. So, bago tayo pupunta dun sa mismong report ko, mag-recall muna tayo sa mga previous lessons na binigay mo po sa amin. So, magsisimula tayo dito sa what is a balance sheet. It is a financial document designed to communicate exactly how much a company or organization is worth, its book value. It achieves this by listing and tallying all of the company's assets, liabilities, and owner's equity as of a particular reporting date. So, ito po yung summary ng overall liabilities, assets, and expenses na meron ang isang companies or organization pinapatakbo ng isang owner. So, next. What is a liabilities? It is consists of money that the business owes to the outsider. So, kung gagawa tayo ng mga business, kailangan natin ng pera. So, ang ginagawa ng mga owner is maglo-loan sila doon sa institution na nagpo-provide ng loan sa mga owners. So, ito yung liabilities. Ito yung pera na hihiramin ng owners sa mga outsider. What is a balance sheet with unbalanced liabilities? So, ito na yon yung main report ko. In this balance sheet example, the business has the higher short-term liability than the working capital. So, obviously, from this example, yung owner ay may mas maraming loans kaysa sa working capital na pumapasok dun sa kanyang mga business, dun sa kanyang agribusiness. So, si owner, magkakaroon siya ng mga short-term loans to purchase sa kanyang mga fixed assets. So, kung babayaran lang ito ng less than a year, papasok siya dyan sa short-term debt. And if time come na yung mga facilities ay mag-i-expire na or due date na at hindi niya na-renew yung mga yun, so may posibilidad na magkakaroon siya ng mas malaking problema. And then, if itong short-term debt ay darating na sa due date, tapos yung pera lang ni owner is kulang or kasya lang dun sa kanyang babayarang loan, so mas tataas yung kanyang liabilities compared dun sa kanyang cash or capital na meron dun sa kanyang business. So, dyan natin makikita yung balance sheet na may unbalanced liabilities. So, keep in mind that entering in business world, you must first fall in love with your work and what you're doing so that in the long run, you have a progressive and successful business. So, thank you very much, Mom, for watching this video.
Hi, good day, Ma'am. I am Rosemary Pagipag, and this is my part of these activities. Example of balance sheet with balanced liabilities. In this example, the farmer has balanced his short and long-term asset with his short and long-term liabilities. The farmer has the same total amount of debt, RON 390,000, and equity ratio have a 35%. But he is in the best position because he or she does not depend as heavily as the renewal of short-term loans to finance the business. This is the example of the balance sheet with balanced liability. Gawin ni farmer ay mag-i-invest siya o utang siya para sa fixed asset. Pero imbis na short-term debt, ay gagawin niya itong medium and long-term debt. Meaning, more than 1 year ang maturity ng loan para sa fixed asset niya.